Hello, this is Bob Steele. In this video, we will be discussing Chapter 2, Learning Objective number 6, which is to prepare a schedule of cost of goods manufactured, a schedule of cost of goods sold, and an income statement for a manufacturer. So we're going to start off with a schedule of cost of goods manufactured. So let's just go through the calculations very quickly and take a look at what it includes. We'll start off with the raw materials that will be included in the cost of goods that manufactured. Obviously, the things that we are producing if we are a production company and producing something like automobiles or something like that, from the production process to the end, from the raw materials to the finished goods. We will have included in the schedule of goods manufactured the raw materials, the direct labor, and the overhead. Those are the three components we're always going to basically talk about when we're talking about the manufacturing, the inventory process, the stuff that we are producing. If we add those three up, then of course we will come up to this number down here. So that's going to be what we have done during the month. Then we're going to add to that what was there at the beginning of the time period, and a year in this period rather than a month. So at the beginning of the period being January 1st, we're adding to 120. So this is what we put in for the year. This is what we had in at the beginning of the year. That gives us a subtotal of 415.1, basically what's available for the year. And then we're going to subtract out from that what is still in work in process as of the end of the year. That gives us our cost of goods manufactured. So now we're going to break this down a bit further and talk about its components. This raw materials up here, we're going to think about how did we come up with this raw materials number that we basically used in the production process. So the raw materials number is going to be similar to a cost of good calculations that we would have done in a purchasing company. Or you could think of it like an inventory. If you were taking inventory and you worked at like a sandwich place and you went in at the beginning of your shift and you had 5 sandwiches, and then the kitchen put in 5 more sandwiches during your shift. That would mean that you had 10 sandwiches available to sell during the shift. If you were to then count the sandwiches at the end of the shift and they were only 3 remaining, then the difference of 7 would be the ones that we would assume had been sold. That's the similar kind of calculation we're doing here for the materials. If we're talking about raw materials and it's like a machinery, equipment, or something like that, then this 6,000 is the beginning raw materials that came from last year's numbers, last year's ending numbers. This year's beginning numbers is the 6,000. Then we're going to put in what we purchased during the time period. So if we're talking about cars or something, that would be steel or whatever that we purchased in terms of raw materials. That would give us our subtotal of materials available for use, what we could have used in the production of vehicles in this case. Then we're going to subtract from that the materials at the end of the period. So we're going to count the material at the end of the period and put a cost onto them and subtract those out. That then would be the materials that would be used here. So of course that's the number that is coming down here. And include all direct labor costs incurred during the current period. So direct labor is much more straightforward. Of course, we're just going to take whatever the labor was that was directly associated with the cost of producing whatever it is that we are producing, and that will go into here. The overhead's like the bucket of stuff that we don't know where to put, basically, so we're going to put them all into overhead. So overhead going to be including indirect material, indirect labor, depreciation on the factory, depreciation on equipment in the factory, that depreciation that's on equipment that's going to be used for the production of equipment, utilities on the factory, insurance on the factory. So any of these things like janitorial costs, any of that kind of stuff that's within the factory, that will be within the production process. On the other hand, many of these things that if they were in a period cost, meaning they were in the administration side, then they would be a period expense and not included in the cost of goods manufactured. Okay, so schedule of cost of goods manufactured, we have the beginning work in process inventory is carried from the last period. So where does that 120 come from? It comes from the last period, and the ending inventory of last period is the beginning inventory of this period. So ending work in process inventory contains the cost of the unfinished goods and is reported in the current assets section of the balance sheet. So there's going to be this 100 here. That's where that is coming from. So then we have the income statement for a manufacturer. So we have the 700,000. That number that's a new number for our problem here. What we're focusing in on is the cost of goods manufactured. So when we talk about an income statement of something that has inventory, then of course we're going to break out the cost of goods manufactured because it's the largest expense. So it's the most important expense on the income statement. So then we're going to break out a subtotal called the gross margin. So the revenue minus the cost of goods sold gives us the gross margin. Then we're going to take out the selling and administrative, the period costs, gives us our income before taxes. We generally have income before taxes because taxes are quite kind of odd and they kind of distort our numbers for one. And two, we need this number in order to compute the taxes, or at least the estimated taxes. And then if we subtract those out, that gives us our net income. So we're focused here on the cost of goods manufactured. And the way we got this, we're gonna get the finished goods inventory at the beginning of the time period plus the cost of goods manufactured during the time period, and that of course came from this schedule here. So the cost of goods manufactured during the time period is included in this calculation, and the cost of goods available for sale, we're going to add those two up. Then we're going to count the goods at the end of the time period, which is the 190, and if we subtract those out, that is what gives us our 115, 110. And that is it for this lecture.